Let me say the quiet part out loud. Buying a home on a modest salary in 2026 feels impossible. And if you're a teacher, a nurse, a government worker, or a tradesperson watching home prices with that slow, creeping dread that it'll never happen, that feeling is real. The market is genuinely brutal. But here's what I'm also going to tell you. Marcus and Denise, a postal worker and a school paraprofessional, bought a home in Dayton, Ohio in late 2024. Combined income, $52,000 a year. Purchase price, $187,000. Down payment, $6,500, partly covered by a state assistance grant they almost didn't apply for because they assumed they wouldn't qualify. Monthly payment, including taxes and insurance, $1,290. It took about 20 months of focused preparation and one honest conversation about location. But they own a home, and you might be able to too. Here's what we're covering. What you can actually afford on this income with real math, the down payment problem and the programs most people don't know about, the location conversation nobody wants to have, how to get mortgage ready in 12 to 24 months. 1. The reality check. What can you actually afford? Let's use $52,000 a year as our baseline. That's about $4,333 per month in gross income before taxes. First term you need to know, DTI, or debt-to-income ratio. This is simply the percentage of your gross monthly income that goes toward debt payments, mortgage, car loan, student loans, credit card minimums, all of it. Most lenders want that number below 43%. So, 43% of $4,333 is about $1,863 per month, your maximum total debt payment. Assume you already have $400 a month in existing debts. That leaves $1,463 per month for a mortgage. At 7% interest on a 30-year fixed mortgage, $1,463 a month supports a loan of roughly $195,000 to $215,000. Add a 5% down payment, and you're looking at a purchase price around $225,000 to $230,000. In Los Angeles or San Francisco, that number doesn't exist as a housing option. That's a real and painful fact. But in dozens of American cities, $225,000 buys you an actual home. Affordability isn't dead, it's geography dependent. More on that in a minute.
Scene 2. The down payment problem and the programs that solve it. Most people on a $40–60K salary are not sitting on $40,000 in savings. The myth that you need 20% down stops people before they even start. You don't. Here are your 3 real paths. Path A. Low down payment loans. An FHA loan lets you put as little as 3.5% down with a credit score of 580 or above. On a $200,000 home, that's $7,000. The trade-off, FHA requires MIP, mortgage insurance premium, roughly 0.85% of the loan per year, which on a $190,000 loan adds about $135 a month. Depending on your loan terms, MIP may stay for the life of the loan. A conventional 97 loan lets first-time buyers put down just 3%. You'll pay PMI, private mortgage insurance, but unlike FHA's MIP, it cancels automatically once you reach 20% equity. That's a meaningful long-term difference. Path B. Down payment assistance programs. This is the section most people skip, and it's the one that matters most. Every U.S. state has a housing finance agency, HFA, that offers grants or forgivable loans to help first-time, lower-income buyers cover their down payment and closing costs. We're talking free money, outright grants, or loans forgiven entirely if you stay in the home for a set number of years. A few examples. Ohio's Your Choice program offers 2.5 to 5% assistance, forgivable after 7 years. Virginia's VHDA grant provides up to 2.5% with no repayment required for income-qualified buyers. Illinois' IHDA program offers up to $10,000 as a forgivable loan. Many of these programs have specific tiers for teachers, nurses, first responders, and government employees, exactly the people watching this video. HUD's Good Neighbor Next Door program offers eligible public servants up to a 50% discount on select homes in designated areas. Start at HUD.gov and look up your state's housing finance agency. Millions of eligible buyers leave this money on the table every year. Don't be one of them. Path C. VA loans. If you or your spouse have served in the military, zero down payment, no PMI, competitive rates. The VA loan is the single most powerful home buying tool available for modest income buyers who qualify. Make it your first call.
I'm not going to tell you where to live. Family is there, community is there. I understand what it means to be rooted somewhere. But here's what the math looks like across different markets. In this table, you can see the name of the city, the average price of a house in that city, and the income required for qualification. Neither path is wrong, but make it a conscious financial decision, not a passive one. One more thing. If your job is remote, geography becomes your financial superpower. Buying in a $180,000 market while earning a salary benchmarked to a higher-cost city is one of the most effective moves available to an average earner right now. Scene 4. Getting mortgage ready in 12 to 24 months. Step 1. Know and fix your credit score. Minimum for FHA, 580. For conventional loans, 620 plus. For the best rates, 740 plus. The stakes are real. On a $200,000 loan, the difference between a 680 and 740 score can mean a 0.5% lower interest rate. That's roughly $60 to $90 less per month, or over $20,000 saved across 30 years. Pull your free report at annualcreditreport.com. Get your credit utilization below 30%. Don't open new accounts in the 12 months before applying. Dispute any errors. They're more common than most people expect. Step 2. Attack your DTI. Every recurring monthly debt reduces your mortgage qualifying power. A $200 per month car payment lowers your maximum qualifying mortgage by roughly $30,000 to $35,000. In the 12 months before applying, eliminate small recurring debts aggressively. Your DTI at the time of application directly determines what you can buy. Step 3. Build your savings stack. You need 3 things in this order. Down payment plus closing costs, which typically run 2% to 5% of the purchase price on top of your down payment. Then a 3-month emergency fund. On $52,000 a year, saving $500 a month gives you $6,000 a year, or roughly $12,000 in 2 years towards a down payment. Keep it in a high-yield savings account, HYSA, earning 4% to 5%, not a standard bank account earning near zero. Step 4. Get pre-approved early. Pre-qualification is a rough guess. Pre-approval is a real lender review of your income, credit, and debts, and it tells you exactly where you stand. Get pre-approved 6 to 12 months before you plan to buy, even if you're not ready yet. It maps out exactly what needs fixing. Also, HUD-approved housing counselors offer free one-on-one guidance, especially useful for navigating DPA programs and FHA loans. Find one at HUD.gov. Know your real number. $52K a year can qualify for a real home in real places. Don't assume you need 20% down. FHA, VA, Conventional 97, and state DPA programs exist for exactly this income bracket. Have the location conversation with yourself. Even if the answer is I'm staying put, make it a conscious choice. And start the prep now. Credit, DTI, savings, pre-approval, in that order. Homeownership on a modest salary in 2026 is harder than it used to be, but the people who get there aren't the ones who earn the most. They're the ones who started preparing the soonest and stayed consistent long enough to finish it. If you know a teacher, a nurse, a first responder, anyone working hard on a regular income who feels locked out of this, share this video with them, because they deserve to know what's actually possible. Subscribe to the channel if you want to understand money better than most people around you. Here you will learn not just to earn, but to manage your finances so that they work for you. Watch the next video and take another step towards financial freedom.